Okay, so here's a video on what's happening in the market right now. And the analytics I'm going to show you, just so that there's context here, are weekly analytics for the last 12 years for GTA freehold properties, not including Halton region. So keep that in mind. Now, first metric we're going to look at is the average sale price. If you look at average sale price last year, at the end of Q1, we started to see the decline because that's when the consecutive rate increases started happening. So we've had the 8th consecutive rate increase as of last week in January, and we're now sitting at 4.5% with the overnight Bank of Canada key interest rate. So we saw the interest rates start creeping up, and by the end of Q1 is when we started seeing the prices started to adjust. Now, every week we're publishing a weekly market update report using these same metrics. And as you can see here, since August, we've been saying that things have kind of leveled out. So if you follow the price carefully, it's kind of sitting between the 1.2, 1.3 range. That's where we're at. It looks like a pretty flat line. Now, when you look at this same report on a monthly basis, you can see that even more so, because weekly you have these ebbs and flows, but it really, you can see that since August, we're kind of sitting at that same price point. Okay, it's on average the same. Now let's go back for a second and extrapolate this weekly again, and let's compare this to another metric. Let's look at the number of listings. And as you can see here, started off the year really strong with the number of listings. We started seeing some interesting things with the interest rates, and eventually the number of listings just dwindled. Now, what's interesting is that listing is the supply, how much inventory we have on the market. When you compare and contrast this with the number of sales, these two charts look very similar. And what they've done is they follow the same trend. Normally, what will happen is if supply and demand are going in different directions, prices will go up or down depending on what's happening. In this situation, when you overlay both on top of each other, you can see they're following very similar trends. And so what's happening is both supply and demand are coming up and down in tandem. When this happens, you see a leveling out, which is exactly why we see the average sale price consistently sitting around the 1.2, 1.3 range. That's where we're at. Now, most sellers that were on the fence about getting into the market have now experienced a year of this. We're literally a year out since this has all started. And most people that were taking the wait and see approach are starting to list. That's why we're starting to see an uptick in listings. Also, we're in January. The days are getting a little bit longer. Last night, the sun set at 6. So things are starting to shift, and it's typical to see more listing come up on the market at this time. But what we're finding is that as the inventory is coming in, it's also getting absorbed. So there's another metric we can look at, which is the ask to sell ratio. And this is an interesting one because a lot of my team members are reporting that they're seeing multiple offers. And so anything less than the 1 mark would suggest that properties are being sold less than asking. If you look recently, we're actually hitting over 1 again, which means that anybody that's telling you that they're seeing multiple offers and properties are going more than asking, this is proof that that's actually happening right now. Again, both supply and demand have come down. Prices have stabilized, and there are certain pockets. This is why it's so critical to look at the micro markets instead of averaging the GTA. You have to look at the market specifically in terms of what's happening in your neighborhood, your postal code, because you're seeing properties with 20, 30 offers even today. And again, most people are indicating that this is probably as high as the interest rates are going to go. And more importantly, if you look at the fixed rates today, it's around 4.3, 4.5% for a fixed 1, 3, or 5-year loan. People aren't locking in for a 5-year term, but many mortgage advisors are saying lock into a 1-year or 3-year. By the time it comes up for maturity, the interest rates should have gone down. Most of the key metrics that we follow on the consumer price index, the heavy items that have skewed inflation on the higher end, are now starting to wash out of the CPI, and we're starting to see that the inflation is actually starting to drop. So cost of living is going down again. Interest rates, as far as we can tell, so far have peaked. They should start declining. Supply and demand are both up and down in tandem, so we're seeing stabilization. And I think this is kind of it. So a lot of the people that were waiting to see what was going to happen have done that. We may either see an influx in listings now and a shortage in demand, which I don't suspect. It could go either way. Nobody really knows. But that's why it's so important to look at these numbers weekly. And on that note, it's also important to understand that many of the major financial institutions are now competing on the rate. So you're actually starting to see some major players go under the prime rate. So you're seeing TD, for example, go prime minus. CIBC, I've also heard, is going prime minus. So these are very interesting thoughts. Most people that are in the market that need to buy or sell, they're going to buy or sell. We're going to see these cycles. And at the end of the day, if you buy and hold real estate for long term, you're probably going to be just fine. Any questions? Reach out to me. Bye for now.